Hey everyone, welcome back to another week of Super Prime UK with your MJ Group Super Prime valuers, myself, Rob Cohen.
And myself, James Wild.
Welcome back everyone. Another astonishing week in the UK. Volatility, uncertainty, governmental change, policy change, interest rate changes about to come in, a new budget about to come in. It is all happening in the UK, and we are doing our utmost here to keep you up to date with what's happening every week in terms of property, lending, finance, the economy, and everything around the valuation space in the UK prime and super prime market. So much to talk about. Let's get straight into it, James. What's been happening?
Thanks, Rob. So just in terms of the data for this week, in terms of sales, pretty good on the new instruction, Rob. 420 for this week, and the other core stat there, sold transaction numbers of 161. So again, above average for this year, Rob. So some fairly strong data, despite certain markets being a little bit cooling there, with obviously anticipated interest rate rises when the Monetary Policy Committee meets next Thursday, 3rd of November. Just in terms of other data, we've got some price reductions are remaining quite strong in the data we have, 224 for this week, whilst good pipeline of sales with 179 properties under offer for this week.
For all of you out there that are asking me what's going on, are properties selling, are people viewing, are properties coming on, I think it's important to say at this moment in time, prime and super prime is performing, and maybe not at the levels it would have been 3 or 4 months ago, but at the same time it is still performing. Properties are going under offer, properties are transacting, and we are seeing a relatively good flow of work in that space. Maybe the remainder of the market, the more standard market, is in a bit of a Mexican standoff, a wait and see, because there's so much happening so quickly that people are making the decision to hold off until they get some kind of certainty or comfort around what the economic policy is going to be moving forward, what the government is going to be moving forward, and how people are going to be reacting to that.
Yeah, no, thanks, Rob. So, a week's a long time in politics, as we always say. So obviously Liz Truss resigned, shortest Prime Minister in the UK history. New Prime Minister Rishi Sunak has stepped in, obviously with Boris Johnson stepping down and Penny Mordaunt not gathering quite enough supporters that reached tipping the scale, that up 100 MP backing there. So we had the Prime Minister in place now, Rishi Sunak. He's kept Jeremy Hunt as the Chancellor with a bit of a reshuffle in terms of his ministers and cabinet. Rob, so the autumn budget has been delayed a couple of weeks to the 17th of November, just for them to base any decisions on the most accurate economic data and forecasting which the government will have. So a slight delay there. Obviously, Jeremy Hunt, we haven't had another change there, so there's some stability in terms of the Chancellor of the Exchequer. One of the Chancellor's first moves, Rob, was obviously to scrap most of his predecessors' plans for the huge tax cuts, with one of the few remaining savings being the small reductions to the stamp duty across the board there, and also the changes to the first-time buyer savings, which are more significant there. So good market, good savings, those first-time buyers up to £600,000.
I think the important thing from the change in leadership is the markets have reacted very positively. The pound has performed strongly against the dollar this week. Let's see how long that will last. Let's see if, when the new monetary policy decisions are made by the Bank of England, the market likes it. Let's see when the new budget comes in, will the market like it? Early indications are yes. As we've seen though in the last period, things can change very quickly.
Yeah, and obviously, Rob, you mentioned the markets there just stabilising somewhat. That has had an impact on interest rates, with some mortgages coming in around 0.5%, so a little bit of a saving there for some consumers against some of the lenders' products. That said, obviously, next Thursday we do have the Monetary Policy Committee meeting, and there's talk of a 0.5% to a 0.75% increase in the base rate. So that would obviously increase some of the mortgage lenders' the charging rates and products there. So again, looking like there'll be another reshuffle in early November in terms of mortgage product offering in the market. Just moving on to that, Rob, Lloyds Banking Group have stepped in and done some forecasting in terms of the UK property market for the next year, and they're predicting around an 8% fall next year in property prices, and then the 4 years after to have quite a stagnant market in terms of growth. What are your thoughts on this, Rob? It's quite a pessimistic view there. 8% fall next year they're predicting.
Predictions are always very difficult. I'm not a lover of predictions. I think there are many variables, and I've said this a lot recently, many variables, economic factors that will affect what happens to the property market, inflation being one of those, interest rates being another, the situation overseas being another, the US being another. There are numerous, the government being another, the budget being another, fuel being another. There are numerous variables. So yes, under certain parameters, it is possible that there could be declines. At the same time, it's too early to say, and we will have to wait and see.
Yeah, and obviously that would far from wipe out the growth that we saw over the last couple of years, with us having double-digit growth, Rob, for many of those months. Lloyds Banking Group, one of the largest UK mortgage lenders, runs the brand of Halifax. Obviously, they're predicting quite a gloomy output for the UK economy. It's actually set aside in its statement around £670 million to cover some of the bad debts arising from the rising interest rates, making the loans, mortgages less affordable there. So they're being a little bit conservative in terms of their forecasting there for the market.
Yeah, a lot of banks are setting aside funds for defaults on the back of the interest rate increases and the affordability issues that they believe we will be facing. At the same time, with the FCA regulations and the changes in mortgage lending and structuring, I don't see that the historical position of millions of people facing repossessions, etc., like we did historically, is going to happen again. I think there's going to be more of a holding of a hand and understanding clients' needs and affordability through that period, hence the reason why Lloyds are setting aside these funds. And I think that's going to be a different approach to mortgage lending and default that we wouldn't have seen previously in downturns.
That's it. Let's not forget, it's the when the base rate is higher, it's the most lucrative time for banks in terms of their return on the mortgage lending over the course of their loans. Obviously, it comes after a time, Rob, where we've had record low interest rates and quite slim margins in terms of the margin they've added on to the base rate. We had sort of 0.83% mortgage deals last year, record lows from the likes of Halifax, Nationwide, HSBC, some of those high street mortgage lenders, all below 1% in terms of their best deals at the most competitive time of the market there. So obviously base rate now at 2.25%, a lot higher. It breaks it down into a much larger margin in terms of what it equates to for the consumer. Rob, in terms of first-time buyers, there's been a large drop in terms of the mortgage deals which are available for them, obviously especially those high LTV mortgages offering up to 95% mortgages. It's going to coincide with the end of the Help to Buy scheme, which is ending imminently. Given some of the Lloyds Banking Group forecasts, which we just discussed, could there be a fall in property price over the coming year? Could this cause a spark in some negative equity cases, possibly specifically in that first-time buyer sector?
As I said, I believe that we're seeing a bit of a standoff at the moment. Many of these first-time buyers will wait and see, so they probably won't enter into the market, which is going to see a reduction in transactional volume, and in certain cases there could be some negative equity if people are forced to sell or in a distressed position. So I think it's too early to make that call. It's possible if there is distress scenarios and forced sales.
Thanks, Rob. And obviously on the topic of interest rates, the European Central Bank has raised its interest rates by 0.75%, lifting its main interest rate to the highest in more than a decade, obviously to tackle inflation across Europe as well. Eurozone inflation currently at 9.9% as of September, Rob. So, pretty similar in terms of the UK as well. The deposit interest rate is now doubled to 1.5% there in Europe. The increase has been expected by economists, and obviously the European Central Bank has a similar inflation target to the UK of around 2%. So, a massive gap there at the moment. The UK and Europe both having 10% inflation at the moment, trying to get that back under control, more towards the target of 2% there. Thursday's rate hike was the third one this year for the ECB, Rob. It's already raised its rates at the fastest pace on record. What are your thoughts on that, Rob?
Well, it may be the fastest on record, but it's still lagging the same way as the UK is lagging the US. So in that order, the US have ramped it up the quickest and the fastest, followed by the UK, and the ECB are lagging behind those two other countries. So yes, maybe it might be a rapid increase, but not at the same pace, nor at the same levels to the UK and the US.
Yeah, thanks, Rob. Just in terms of some news, in terms of some other global economics, the gross domestic product, the GDP of the US, has actually bounced back in the last week or so of data being released. Third quarter, reversing its trend over the last 6 months, suggested that the country was heading for a recession, but the country's GDP increased 2.6% between July and September of this year, reversing that steep decline which saw a 0.6% decrease in the previous quarter. Much of that growth, Rob, has been put down to the increase in the US exports and a slight decrease in terms of their imports. There's been a bit of a cautionary note from some of the economists saying they're remaining slightly pessimistic about the economic climate there, with signs of consumer spending starting to dampen, and obviously heading into the winter months where consumers are going to be hit more by the cost of living as the heating bills start to ramp up across the world, that is. So it's going to be a bit of a wait and see moment in the winter months, not only in the US, but in the UK and across Europe.
Thanks, James. Last comment for today. I've got some good feedback that we've received from a previous show on the IKEA dropping their prices on the back of distribution, backlogs easing, costings falling, which was a really positive sign, and I think a great indicator of a bit of light at the end of the tunnel. Just to back that one up, been tracking the cost of containers for shipping and distribution of goods, and that little tracking, this is a good one for you. Pre-COVID, we were at £3,500 more or less for a container. It went all the way up to nearly £20,000 during COVID, when you had that spike of backlog and challenging costs in distribution, especially with the PPE. And the good news with that, it's come all the way back down to £4,500, near pre-COVID levels for container and shipping. And I think one of the possible indicators there is a lot of those costs would have been passed over to the consumer, which in turn affected inflation in terms of pricing of goods going up, which we saw with the IKEA example that we previously reported. Now, if those costs of distribution have come down so dramatically and returned to broadly a similar position to where they were pre-COVID, there is the possibility that the knock-on effect of that is that pricing for certain goods could come down because the backlog has been eased, distribution costs have come down, timelines have come down, and that all could mean that a part of the effect of the inflation we're seeing today will diminish, and that could be a turning of the corner in our fight against inflation.
Thanks, Rob. I mean, just in terms of the heating bills and the fuel caps which are being put in place at present, that was meant to cause a reduction around 4% in inflation. So as we come into the spring next year, we're going to have to review how that has impacted the inflation figures. Hopefully, will be that will have filtered through and will be closer to that 5 or 6% inflation in the UK economy, being able to get that down slightly.
Yeah, I think the double whammy there is get through a winter, hopefully it's a mild one, but get through a winter, have the distribution and the shipping costs come down. The two together, when you hit April, May of next year, could pull that inflation figure down, and then the economy can move from there. So hopeful signs, very early days, but something to look forward to in April, May of next year.
Rob, I think you might have coined a new term there in terms of the market conditions at the moment, Mexican standoff. I wasn't quite sure of the definition. It's not one I've heard before.
So a Mexican standoff is where there's a stalemate, where neither side wants to move because they're both scared of losing out, and thus you're in a position where people are either not buying or not selling, and everything's stuck.
Okay, yeah, no, I mean, it's a pretty accurate description at the moment. Obviously, I think in the property market at the moment, there's a lot of sellers in that particular standoff at the moment, and I think a portion of the market is coming round to the market conditions of the cooling. It's why we're seeing some of the more price reductions being more prevalent, but ultimately the transaction volumes are lower than what they were in 2021.
Thanks, James. Quick reminder, everyone, watch the EVA show, the Super Prime UK special from Germany. Great update, great data, great intel, pan-European and everything that's going on in the German market. And we'll see you all next week. Thank you. Thanks, James.
Thanks, Rob. Thanks very much, everyone.